May I use an agreement that I'll buy the car in the next 2 weeks. The contract in itself is a financial asset. However, if your car does not exist, that financial contract will never come to life. Does that make sense? So, and what I'm saying here is every contract must have an underlying asset, must be based on an underlying asset. Those are things that you're getting to check. Yeah, but all I'm going to do here is I'm just going to touch very fair. Yeah. Your contract can be either physical or cash settlement. Now, what do you mean by physical or cash settlement? In the future, when the obligation is to be taken, you can either in the future, your financial contract, upon fulfillment of the obligation, it can either be cash or physical settlement. What do you mean by cash or physical settlement? Physical settlement means, Mr. Abiodun, you want to sell your car to me in the next 2 weeks. After 2 weeks, I will pick up your car and give you the agreed price that me and you decided to transact. Now, in between the day you enter the agreement and the day you decided to fulfill our obligation, the price of your car will change. So the price of the car today is 1 million. In 2 weeks' time, it might not be 1 million, but 1.2. But because me and you have agreed that it is 1 million, we will transact at 1 million, irrespective of what the future price. So physical settlement means I take the delivery of your car and I pay you 1 million. Yeah. Cash settlement means in the future price of your car is 1.2. But me and you agreed 1 million. So rather than you giving me this car, what does it do? You give me 200,000 naira and tells me, boss, this 200,000 naira, add it to your 1 million naira you want to give me. I'm gonna buy your car in the market. I am not giving you the car. Does that make sense? Does that make sense? Does it make sense? Yeah. So rather than you give me your car, you tell me, hey, I'm not giving you my car. Take 200,000 naira. Add it to that 1 million that you want to give me today. Add it to it. Go and buy your car in the market. I am not giving you that car. That is cash settlement. Yeah. But physical settlement, I take delivery of car. So those are the
But does this really happen?
yes. Does this really happen in reality? Yes. Nobody takes delivery of food.
Yeah.
Nobody takes delivery of food. But we trade food. We use which part of the things I'm going to talk about now. We use forward and future contract to trade food. But nobody takes delivery of food. All I want to do is at the future, at the day of fulfilling my obligation, what is the price of crude oil? If price of crude oil is higher than the price that we agreed, I'll be expecting whoever I transacted with to give me that differential. And if it is lower, the person is expecting to pay the differential. You will learn all that from that derivatives. Yeah? So we have different types of contracts. We have forward contracts. Yeah, forward contract is exactly what I just described now. Forward contract. There's always a buyer and there's always a seller. They come into an agreement to fulfill an obligation in the future based on a price that they agree today. That's the forward contract. The thing about the forward contract is, do you guys know what we call an over-the-counter market? An over-the-counter market is a market that is not technically regulated. Yeah, but me and you trade bilaterally. We transact bilaterally. The bond market in Nigeria is an OTC. I can just call anybody and say, well, Safa, we have to say yes. I want to sell it to you, or I want to buy it to you. I want to buy it for you, and we transact on the phone. Yeah. So that's forward contract. But I mentioned we learn a lot about that. Sorry, please. Okay, so So those are forward contracts. Now, the issue with forward contracts is that, like I said, they are not particularly regulated. And because they are not regulated, there is a particular risk that you are exposed to. Mr. Abiodun, do you know the risk? So your name is Sam here. Sam, sorry. Do you know the risk you're exposed to? If you are following me, Mr. Sam, what risk are you exposed to in this kind of environment that I'm explaining to you? What's your biggest fear? If I come to you and say that I want to sell my phone to you next 2 weeks, me and you are doing 500,000 naira in next 2 weeks. So your biggest fear. Is that what's your biggest fear? So we are also building. Listen, build who is that going to this farm? What's your biggest fear?
I will use it.
That's the extreme. What's your biggest fear?
You mean that I'm people?
No, if I come to you now and I say, it's a forward contract. I come to you and I say, I'll sell this phone to you next 2 weeks. I find out there. Me and you shake up, you agree. What's your biggest fear?
Default
Risk. What do you mean by default risk? Let's keep it simple. What do you mean by default risk? Equity investment. So I'm teaching equity above money. Sir, Mr. Bellu, keep it simple. What do you mean by default risk? It's not the one that understand big English. So what about big default risk? Let me help you. Let me help you. On that day, you will see. That's your biggest risk. That's your switch on your called default risk. That's the simplest risk. The fact that in 2 weeks' time, you will call me, you will not see me. You come to my house, you will not see me. You will find me, you will not see me. While you have paid 500,000 naira with the expectation that you'll be able to buy correct food in 2 weeks' time. That's your biggest risk. So, in order to cut that risk, we're now saying, can we bring this kind of transactions, can we bring them to an exchange where the exchange helps us to eliminate that default risk, which we don't call it default, we call it settlement risk, to eliminate that settlement risk. So the exchange standardizes those contracts and tells you that if you want to guard against this risk, come and list or come and buy this contract off an exchange. That was what brought about what we call futures contract. Futures contract and forward contract are the same thing. It's just that forward contract is both futures contract is both exchange traded. So you can see a standardized forward contract for which so that is forward contract. Like I said, I will not go deep into it. Your derivatives teacher is going to teach you.
So my communication on that, your last one. Forward contract is
OTC, futures contract is exchange traded.
so which of the other two that is different?
Gross, please, I beg you, they will they are not writing in Nigerian example.
Okay.
Please, remove your mind from Nigeria. That anytime you are doing CFA, imagine that you are in America, forget Nigeria, I use God name make rules. So please,
No, what's the local example?
leave local example. Leave local, you know that what is in America, it's not in Nigeria. So Nigeria likes it, and we have a way of, as I said this yesterday in one class, Nigeria has a way of creating its own. So I will not tell you what is similar in Nigeria. It's no similar in Nigeria. We are writing an exam, Nigerian exam. Leave it like that. Second is another type of contract are swaps. Yeah. What do you do? What do you do? You are an author. So right now you are an author. So I've heard of swaps. Should have. And chartered accountant. So I don't need to explain what swaps are. Anyway, so what is something is swap? Forget I call it swaps. When is it swap? What comes to your mind? Actually, like Americans, they don't spend themselves. What is the swap? Bring your shares, bring my phone. That's it. Me and you now agree that you see this thing that you have done, we'll reverse it after 3 months. Let me give you a gist. Are you very conversant with what is happening in Nigerian financial market? What are the where was CBN saying? I mean, what did CBN say last week when it was banks go and sell on their it's like, I spoke to somebody who the ones that want to do that. The assets you have must correspond with the liability you have. So what do they owe? And how do they pay liabilities? They can't fall contract. They come to you and say, "What's Alpha? I have $1 million. Come and give me the Naira equivalent. Take, collect, send me the equivalent. We give you the dollar, collect the Naira. After 1 year, after 9 months, you swap it back. You can do say after 9 months, what we do? You swap it back and swap it again. But the only thing that's happening there is, what is happening there is, the dollar that I gave you, the Naira that I gave you, you know what's going to happen? The Naira that I gave you, you will pay me Naira. The dollar that I gave you, I will pay you dollar.
So how do I do this online?
Liability. The liability. The liability.
So the banks trying to be half smart.
It's not smart. When the person told me to say that, and I said, why they don't? What you see, at times you might not think, but you might not think it. She didn't say that. I said nothing. She just said, "Why you don't say my it's called this financial statement, boo. So what I just do is I record you my books that I've loaned you dollars. Liability. The asset has not become a liability. And you pay me dollars, and I'm paying you Naira.
So I think there was these old big guys selling off their shares and trying to it's only maybe down for it's open now. If it is. I'll never forget this. Maybe I'll look for it now.
What? Mr. Biodun, you are not saying that. Fantastic. So these are swaps. A typical example of swap. What is swap? Most times this way is common. So let me explain. So a farmer and as a farmer, You have harvested your crops. But Mr. Samuel has told you that those crops that you have, deliver it to him in 6 months' time. But you need capital. Are you are a farmer. You have harvested your crops, your cocoa. You are meant to supply cocoa to Mr. Samuel. And Mr. Samuel said, supply cocoa to me every 6 months. And you are in month 1. And you already have the cocoa. And you are telling yourself that, if I keep this cocoa and not sell it, if I sell this cocoa, I've disappointed Mr. Samuel. Because of taking another, like, let's say, another 1 year to do. So what do? You enter a swap agreement with me. You give me your cocoa, and I give you fat. Whatever cocoa is at the end of 6 months, remember that, let's say the cocoa is valued at 1 million naira. By the time you deliver it to Mr. Samuel will give you 1.5 million naira. But the real price of cocoa at the time of delivery to him is 1.2. So what me and you agree is that you see that differential between 1.2 and 1.1, you give it to him. Then I return the cocoa to me. And we divide the cocoa to me. So you see what has happened? Did you see what I just, the picture just made like this? He's a farmer. He has got into a contract with you. You are listening. Yeah? It takes him 1 year to be able to get cocoa ready for you to supply. But you have a date, a period where you receive your supply. And that date is 6 months ahead of when he had the tons of cocoa. So he has 2 choices. He waits for you, or he sells it. But you see the truth. The value of the cocoa today is 1 million naira. If you wait, the agreement he has with you is you pay 1.5. So at the point of delivery, he will receive 1.5. But today, cocoa is 1 million naira. The cocoa that he has is 1 million naira. 6 months difference. So what does it do? It comes to the letter of commodity swap. So what's the commodity swap? It gives me this cocoa, I give him 1 million naira. But we enter an agreement that this swap is for 6 months. Because he needs to take delivery of that, receive that cocoa back from me to me to supply it to me. So what do I tell him? I say, see, bros, when after 6 months, I don't know about both of these transactions, but my own is after 6 months. Whatever the value of cocoa is what you pay me back. Then I'll give you power. Now, fast forward 6 months. Cocoa is now 1.2. Remember that to you is 1.1, they're paying 1.5. So what does it do? It gives me 1.2. And I give you the cocoa. And it delivers the cocoa to me. Or it tells me, bros, wait to cheap. I have an agreement with Mr. Samuel. If I take this cocoa from him, I will deliver the cocoa to him and he will pay me 1.5. Upon the receipt of the 1.5, I will give you 1.2 and then I'll go over. So I agree with you. I deliver the cocoa to you. You pay 1.5. I take my 1.2. I pay you 300. That's the economic.
Is it possible that the commodity becomes less right?
Yes. That's the risk that I want to take. That's the point. If I feel the commodity price will be lesser in 6 months, I will tell you. But me too, I have looked at it that this commodity price. The only problem we would have is his prayer will be that the community value does not go above 1.5. Because if it goes above 1.5, that means it's owing me money. So that's the community swap. Equity swap is like that. Sir? Okay, please go ahead. What's the blue? Continue, go ahead. I will increase the volume.
Okay. Alright. So I was saying that is it the 1.2 that is fixed ahead? Or is it that the 1.2 million? So the 1.2 million is fixed ahead before the 6 months time.
No, so what is fixed ahead before the 6 months time is the future value of people that me and Mr. Biodu or me and the farmer we don't know. So that's the risk that both of us are taking. It's like see what I always tell you that majority of these things is like bets. We don't know the future. Yeah, that's my point. But what is certain here is that we have to. And me, I'm saying I feel that Cocoa is going to go. So hey, my brother, I'll give you 1 million naira now. I'll hold your Cocoa. After 1 year, whatever the value of Cocoa is, I will give you back your Cocoa and give it to you. And like Mr. Samuel said, what if the price of Cocoa dips? I'm at the loss. Because that's the agreement that me and you have entered. And it will be unfair to say, okay, we can make it possible here to say, you know what, after 6 months, pay me back 1 point. I don't want to care where the value of Cocoa is, but I want to know sweet. If I believe so much in the fact that Cocoa price is going to go up, I will fix at 1 point. I'll tell you whatever the future value of Cocoa is. And one thing I've noticed about this is that this kind of transaction is that you believe in your own conviction. I believe my conviction. You believe that Cocoa price will not go up. I believe that Cocoa price will go up. Yeah, I hope I'm able to explain.
So that 1.5 that you will let me try to say about your initial buyer. How do you fix that 1.5 with your initial fix?
So that's what I'm saying now. The farmer already has a contract, already has an LPO with Nestle that is already fixed at 1.5. It's already fixed. I don't, as the counterparty, I don't even need to know about that transaction. But I'm just putting that transaction in so that everybody can understand and just have a total picture of what I'm trying to explain. Okay, so moving on. Yeah, thanks a lot. So moving on to options. So options is like forward. Yeah. Now let me go back. Remember when I spoke about forwards? I said both parties have a future of engagement. Yeah? What that means is that in the future, you must Mr. A, the buyer, and Mr. B, the seller, must fulfill their obligation. Even if they are in a loss, nobody cares. You must fulfill their obligation. Does that make sense? However, for an option, the buyer has the right to exercise or not exercise. Does that make sense? So let me give you an example with example. I gave you an option, I sell to you an option to buy my phone in 6 months time at 200,000. Because you are the buyer of the option, I am the seller of the option. Did you get what I said? I am selling an option to you to buy my phone
in 6 months time. So here I am the seller. I am the seller of the option to buy. Yeah. So I'm telling you, come and buy this option. Because you are the buyer, in 6 months time, if the price of the phone is 150,000 naira, you don't have to exercise it. Where's that option? Where's that option? So what I always tell people, your derivatives teacher will explain it better. Yeah? But what I always tell people back in the days is that an option is a contract on a forward contract. An option is a contract on a forward contract. Mr. Bello, do you agree? No, don't say God and talk. An option is a contract on the forward contract. So what's the forward contract? The forward contract is a contract that me and you buy or sell. You buy for me, I'll sell for my phone. I now tell you that on that forward contract, I am selling to you an option to exercise that forward contract. So normally for forward, you don't pay anything. For me I need to enter a forward contract. There's no consideration that is paid at the beginning. Does that make sense? However, for an option, there's something to pay at the beginning. That is why the option is a contract on a forward contract. So there's an existing contract. I now tell you that I am creating an option on that contract. Just what I'm saying. So that I don't complicate, I don't like to teach things I don't teach. Let me explain something. This is better. Yeah. So there's a forward contract to buy. Yeah. A forward contract to buy a phone at 200 naira in 6 months. Now, what do I do? I can either be a buyer. So this is an option. Now, the option gives you a right to buy. So this is already existing, or this is what the underlying is, and I'm giving you an option to buy a phone. So because it's an option, in 6 months' time, what the option does is you don't need to exercise this guy. You can either exercise or you don't need to exercise. And in order for you to have this option, you have to pay. So for an option, you can either be a buyer to the option or the seller of the option. So if I am the seller, I am the one that is coming to you to tell you that, bros, there's an option to buy a phone at 200,000 naira in 6 months. Are you interested? If you say you're interested, I'll say, pay me 5 naira for you. That 5 naira is not part of.
That 5 naira is not part of this guy. That 5 naira is you paying for that right. Does it make sense? Is you paying for that right? When you now pay for the right, what do you now do? You now come on the queue and be waiting for 6 months time. Then in 6 months time, you now ask, so how much is this phone now? They now tell you that the phone is 300 naira. What will you do?
You exercise this guy, don't get it cheaper. But you don't have to do that price.
No. If you exercise this guy, that means doesn't mean if you exercise it, they are binding. This contract is not binding on you. If you do not exercise, what do? You walk away. So
That's why I keep telling people that the option is a contract on a forward. At the end of, at 6 months' time, you can make that. If you exercise that contract, then it means, if you exercise the option, then it means that you want the forward to be binding on you. And once you exercise, what the next amount of forward, you must fulfill that obligation. So the moment you exercise the option, you must fulfill the obligation.
Exercising means paying for it.
No, exercising means I am not interested in this now.
That's after 6 months.
After 6 months. You cannot decide until 6 months. What will make you decide is the market price of this phone, which is 300, and the price they are quoting in this contract.
So I do not exercise.
If you do not exercise,
What I pay there for the
5 naira, that's all. That's although your derivative teacher, will do justice to that. But that's the trick about that option contract. Let's see. There are other contracts that you see in your life. Insurance contracts, credit default swaps. You know, credit default swaps is what killed America. Can you guys remember? That's what they used to kill America. Credit default swaps. So do you know what credit default swaps are? You buy a bond. Yeah. You buy a loan. You know that the person will not pay back. What do? You go and sell it to a transport. Yes, sir. You buy it.
when they know it's going to pay back. When they don't know you get back.
No, you don't understand. You see what I said then? That for contract, each party is running on their own view and expectation. You are the one that is saying that what it will go back. For the insurance company, by saying in their own words, it might not go back. But build all of them went back. As all of them went back. Well, remove. So, any questions? Any questions? Any questions? Let's now move to financial intermediary. Financial intermediary. Financial intermediary. Financial intermediaries. So what are financial intermediaries? Financial intermediaries are those entities within the financial market that help you to facilitate transactions within the financial market towards achieving your financial goals. So those are entities like banks, mortgage banks, commercial banks, investment banks, stockbrokers, exchanges, arbitrageurs, clearing houses, mutual funds, insurance companies. So all when you get technically, when you get entities within the financial services sector, all those entities are what? Their existence is for you to achieve a particular objective. If you want to buy stocks on the exchange, who you go with? Stockbroker. If you want to collect loan, who you go with? Bank. If you want to raise capital, who you go with? Investment bank. If you want to manage your money, who you go with? Fund manager. They are all what? Financial intermediaries. The fact that they are existent is towards what? Achieving that goal, financial gain. They are all financial intermediaries. I can't start telling you guys about brokers and exchanges. Investment banks. You guys know what this is. So do you guys have you guys heard of dealers? When you hear dealers, what comes to your mind? I heard you work in a stockbroking firm. So you know what dealers are? Dealers are guys that create liquidity in the market. Yes. Then the guys that always want to buy and always want to sell. So they are not like brokers. Brokers have only one objective, which is to execute their client's mandate. But dealers are not there to execute mandate. Dealers are there to provide liquidity, to ensure that there is a smooth and free flow of transactions in the financial market. Arbitragers are guys that are opportunists. All they're after is to look for an opportunity to buy, an opportunity to sell. They are very different from speculators. Yeah, they are different from speculators. So they identify opportunities to buy and sell and take advantage of it. So most times what they are looking for is what is pricing. They are looking for is pricing in the market. Yeah.
Who does the pricing?
Who does the pricing? Pricing is what?
Of what they are looking for in the market.
It's the market that does the pricing.
No, you know, the market is going to get the pricing. I feel like I'm going to do it. I don't know what
It's going to be
very flat. It's going to be the same approach. So if they are taking opportunity, they are taking advantage of more market against. Is that how it looks? I don't know.
that's one of the several opportunities. So let
Just so you are not understanding, I saw something like the
me explain. Do you know Excel?
yes.
Excel is traded in Nigeria and in the UK. For the past few years, there has been an arbitrage opportunity. What is the arbitrage opportunity? Excel is Excel. It's same Excel. It's not too Excel. The price in UK is less than the price in Nigeria. Yes. That produces an arbitrage opportunity.
And is it not better here?
Same Excel.
Better Nigeria, better UK.
Excel Nigeria.
Selling in UK and selling in Nigeria.
So how do you take advantage of it? Buy both execution. Now the problem now is how do you carry that stock from UK to come and sell it in Nigeria? That's where the common problem is. So by the time you look at the cost of doing that, it might be what? It might eliminate that arbitrage with pricing that you see. Yeah? But some people are still doing it. So prices are determined by content. Okay, securitizers. Have you guys heard of who they call securitizers? So let me explain. Remember when I said credit default swaps? There was an instrument that was created called collateralized debt obligation, CDOs. Collateralized debt obligation. Now, it was securitizers are the ones that created that security. So I would say securitizers are the people that create securities using other securities. So what do these guys do? They call, you know, mortgage is big in America. Mortgage is not big in America, it's big. So you go to government with all the mortgage companies and tell them that, guys, see, anybody that has this level of rating, risk rating, high risk rating in the organization, bring them to us. We have an instrument that we use to pay back. Does that make sense? let me read to be the way I said it. Someone is a mortgage guy, is an individual. You took mortgage. You are the mortgage company. I am the securitizer. Yeah. You are giving money to someone to buy a house. Someone is now paying you what? Someone is paying you monthly interest. Have you? You pay him 100 million naira to buy a house. He's paying you monthly interest of say let's say 100,000 naira or 200, 300, 500,000 naira. Whatever. Then I now come to you and tell you that I want to buy someone's mortgage from you. So what? So give me a price. Now you are buying the price. I pay you. But someone cannot pay me. So what do I tell you? I say, you know what? I'm going to create an account in your bank such that anytime someone pays you, you credit that money into my bank account. Now, there are more than 20 million of salmons. And so I now meet you and tell you everybody that fits the criteria of salmon, give it to me. I'll pay you for that. For the mortgages. So what do I do? So now let me explain something. Imagine someone is paying you interest at 1%. Give me a percent. 28. Then you know the market is paying you at 28%. The money that I'm using to pay you, I got it at 14%. So usually you guys based at 14%. Yeah. So I have the ability of 14%. But I'm receiving funds from you guys that is running at 28%. So that differential of 14%. It is like you don't get that. Does it make sense? Now, what led to the financial crisis in 2018? Sir?
How would I get if the investment in the market is not 8%? Where would I get 40%?
Don't worry. Investment rate and borrowing rate are two different rates. The people that are giving me money is investment rate and borrowing rate are two different rates. The people that are giving me money, they will gladly give me money at 40%. They will gladly give it to me at 40%. Investment rate. What is the rate of treasury bills now? So imagine I'm telling you to give me is investment rate. So I've created a fund. I've created a fund. You are getting my point. I've created a fund, and that fund I've told people to invest in it at 16%. You are getting my point. And I'm not going to build a mortgage company. I tell you that I want to buy Samuel's mortgage. Remember that the money that I've paid Samuel, the security to that money is your mortgage, it's your house. So it is securitized, perfectly securitized.
Another question. I will buy this completely off.
Yes, completely. But I'll pay it in future because. So the question he asked is, am I going to completely buy the mortgage of the mortgage company? And I said yes, but I'll pay the mortgage company because the mortgage company will continue to collect your interest on my behalf. So I pay.
Why would I want to say?
Let me explain. This is a capital problem. This guy has the maximum capital that he has is 1 billion naira. And he has exhausted 1 billion naira. And I talked to him and I said, bro, let me buy off all your mortgages of 1 billion naira to create more capital for. So this interest that they are collecting from Mr. Samuel at 28, I'll buy it from you at 25. So you see what I'm happening. So every time you pay 28, he takes 3%, he will give me 25%. Me, I will collect 10% and give my people 15%.
So you are
I'm the securitizer.
examples of securitizer.
It's very.
No, I'm not
It's
asking.
very. Now, following this guy's friend, leave Nigeria alone. Like, let's be honest. Now, let me now give you the truth. The truth is, let's see now. Let's continue to talk. Yes, what that caused the problem in financial crisis of 2018, you know, and that told him that I don't want to be like someone. I want this to have big risk. You know why? Because the interest that you would have offered you, would have charged you, would be as high as 40%. Do you know what I mean? Because I know that, let's say this guy, let's say Mr. Abdul is those category. Because I know Abdul is going to default. What do I do? I'm sending you a rent. What do I do?
That's what it is. They actually paying you.
So it's not that
Was it?
it's not that
Yes.
I bought the loan from him because I knew it was default. I sold that default risk to the insurance company. So you know what happens? If the default, insurance company will compensate you.
So they will protect.
That's what comes to the other person of 2008. So you see that I'm sorry to say, instead of I'll pay insurance company premium there. I'll pay insurance company premium. Yes, sir. I'll pay insurance company big premium. Remember that I'm already making big money for this business. So I don't mind taking 5% of it to go and pay insurance company. Have you guys seen what's going on? I see what's going on. I want mortgage for 1 million. I've given him 3 I've said, okay, you know what, Baba, I don't want to do this salary again. I want to do the 40%. You sure what's happening? Yes?
All I'm saying is that we are just passing a bit more percentage.
Yes, now. Yes, now. That's it.
That's like the only person that.
That's why the person that was holding the ball at the end of everything when the federal council was insurance companies, AIG and that's why federal government federal government of US had to deal with the problem.
The insurance company that
For where? To who? For your
The only person that provided.
the what?
They just.
the government, but the government and the government.
Yes, sir.
But the only person that provided the utility time was you.
Yes, sir. Yes, sir. So you know what this guy did? When this guy made Alex, what he said? This guy started selling, writing mortgages to doors. To fictitious people. Lying to me that they were written different kind of mortgages. Some 5%, we are not buy it.
So you just buy, you don't do it.
Me, don't waste my time. Me, once I buy, I call insurance company and come and collect your own pots. Insurance company to collect. I'm praying that
What I'm saying is that no document from insurance company. What I mean is that who can check the mortgage,
oh God. See, you know that I said something yesterday that you see all these things that you said. it's hard for me to believe that financial crisis it was not organized crime.
Because I wonder
How
how
would I buy something from the house and go and check that the mortgages are existing? So you guys giving me fake mortgages.
that's why I'm surprised.
You
Like,
need to attend by fake mortgages. You need to attend cutting after that spread to insurance companies.
it's organized crime.
And insurance
Someone
companies,
is taking the full risk to not check. It's organized crime.
yes, you have you guys heard of depository? FMGQ. FMGQ has a depository. CSCS is a depository.
Oh, okay.
So those are guys that they partner with exchanges to hold assets. They are getting to the point. Do you guys know what custodians are? Custodians are also the depository. In Nigeria context, custodians are also the depository. So they are just their financial asset banks. They don't hold cash. They are just holding security, holding investments. Those are the depositories. Obviously, everybody knows what an insurance bank is. An insurance company. I don't need to define what an insurance company is. Moving on. See, settlement and custodial services. Yeah. So in Nigeria now we have one settlement bank. Almost all the banks are settlement banks. There was a company to settle law that they became prevalent in the bond market, fixed income markets, to settle your treasury bills and your bonds and all that. So if I'm buying a federal government bond, I have to have a settlement bank that I'm registered with CBA in order to be able to settle the transactions on your behalf. Yeah? So almost all banks are settlement banks. Then custodial services is what I just said now. A custodian is like a depository, but depository is more tied to an exchange, while custodian is acting on behalf of investors. So they hold your securities on your behalf. Yeah. That's all right. Very, very theory there. Okay. Positions and short positions. So when you hear I'm taking a position, it means that I am exposing myself to the risks associated to a particular security. Yeah. So I want to take ownership of the security. Yeah. So you can either have long positions or short positions. My own definition of position is exposing yourself to the risks of a security or an investment. Yeah. So you can either have long positions or short positions. For long position, it means that you benefit when prices go up and you are impacted negatively when prices go down. While in short position, you benefit when prices go down and you are impacted negatively when prices go up. Should I say that again? Long position, I benefit when prices go up. I am at a loss when prices go down. Short position, I benefit when prices go down, and I'm at a loss when prices go down. That's the difference between long position and short position. So short selling, have you guys heard of short selling before? Short selling, it means when you buy an asset that you do not own And the only time you know when you sell an asset that you do not own, that's short selling. And the only reason why you sell an asset that you do not own is because you anticipate that the price of that asset is going to decline, and you buy back that asset when it's cheaper. That example, I have this phone. There's this phone. I want to sell this phone to Mr. Bill, but I don't have it. So what do I come to? I come to you and I tell you that, sir, do you have this phone? You say yes. Can you borrow me for 2 weeks? You say, I don't have it. And then I'll feel bad in 2 weeks time. I'm not worried, I'll feel proud of you. You say, okay. But when you're coming back, you tell me when you're coming back, we'll give you something. And so wants to say, give me stuff, I say, you don't collect this thing from you. I send it to you. And it's already there. It's already there. That is how of that. Fast forward 2 weeks into the market, the price of the phone has declined to 400 naira. So what do I do? Remember that I have sold the phone to him, I mean 600,000 naira. 2 weeks time, the phone declines to 400,000 naira. What do I do? I go to the market, I buy the phone at 400. I give this guy, I say, bro, I'm back. The phone that you borrow me, big, tear over. Sir, you know that you go, the man will go, sir, they took back 50,000 a day. You say, when you like, you do that kind of person, I can tell you that kind of thing. That's what I'm saying. And you see, you have to tell that kind of person. Can you tell that you like him?
So without mentioning, like the market is where biggest are they people that are involved?
Yes, security lender. We are not called security lender. So the market is not in town. So let's give an example. Stanley is a security lender. Securities. So it's typical example that as I'm talking to you, I said, I think I need to bring transaction to money. As I'm talking to you now. So yields are going up. And the best thing to do is, that means prices are high. Prices of gold are. So I can go to Stanley and say, Stanley, give me 1 billion worth of bonds, sell it to the market. The price goes down by maybe 10 naira. And what do? I buy it back. I give it back to Stanley. And I collect the difference. This is the level that everybody goes. Stanley says, for them borrowing me, I'll pay them maybe small money. So you don't money. I do my calculation and I pay them back to small money. Not exactly.
I would have thought CBA was the best way to do
CBA.
I didn't know the
CBA has one function. Regulate costs, yes. And moderate inflation. It's not that we want to work on that. Any other work beyond that, they have turned the bank to what we really turn the bank.
I'm just thinking that it's risky for Stanley borrowing us who's a security to do. I think it's a government that in case the bank.
Okay. So that's short position. I think I get what they call it's the same thing as the leverage position. So leverage position is the same thing as not necessarily like short selling, but it's like short selling. So the leverage position is let me explain what leverage position is. Some want to buy an asset, and I told you that the minimum value, minimum entry for that investment is 1 million naira. You check your account and you realize that you have only 500 to 100. For that investment, if you put 1 million naira in 1 year to give you 20%, you have done your analysis, you have done everything, you have checked it, you have realized that this thing is secure. But you don't have 1 million naira. So what you do? Go and meet Mr. Bill, go and Mr. Bill, have fun. Come and give me 400,000. So Mr. Bill say how? So because you're my classmates, when I like you, and all that, you're a great guy, I'll give 400,000 naira as 15%. So why? Thank you very much. Collect 500,000 naira. I see your 500,000 naira. And make an investment. After 1 year, you now have 1.2 million naira. How much are you willing to sell? Now we need 500,000 naira, 575,000 naira. Yeah? So what do you do? You remove 575,000 naira from the 1.2 and you give it. What are you left with? You are left with 615 naira. Yeah? So technically, what you have done is you have invested 500,000 naira to get 415,000 naira. What's your return? Your return is probably 25%. You order 25. You invested 500 to get 125 because you gave me 525. So then you are getting 25% return on the investment. That's the leverage. That 25% ordinarily you should have earned it because the investment itself was what 20%. But because you borrowed to invest, naturally, if you are not waiting to say, you know that this would have done, that wasn't that Mr. You know, or investment for 1 when you 20%. We have our own. The investment point, in that case, you go with 20%, you will go to 20%. But because the minimum is 1 million naira, both of you are able to gather money together to get what? 20%. But you went to him to tell him, and why can't me? Come on, borrow me 20, come on, borrow me 500,000 naira. That 500,000 naira that he borrowed you, because he lent you. He lent you at a rate that is lower than that 20%.
So what was the position that is leveraged?
Your own position is leveraged. Your own position, your 500,000 naira. The fact that you earn more than 220% means that your position was leveraged. So that is what. So when we say leverage position, no, your investment is a leverage investment because it's not only your money that is there. You have your money and borrowed funds. Orders and execution position. So when you want to make an investment or to buy a stock from the exchange, you have to place an order. Yeah. So your order is like an instruction to buy or sell, or an instruction to transact. So that message is what we call order. So if I want to buy stock from an exchange, I send an order to the exchange. Yeah. So it's a means of communicating what my intention to transact. Yeah. So we have different types of instructions. So every order has instructions attached to them. So we have different types of instructions. So we have different categories of instructions. We have the execution instruction, we have the validity instruction, and we have the clearing instruction. Yeah. So the execution instruction is what tells what you are communicating what you want to buy, and the quantity you want to buy, and at what price you want to buy. So your execution instruction has what I am buying, the quantity I am buying, and the price that I am buying. Your validity instruction says how long that order is available in the market. Is it for a day? Is it for 2 days? Is it for ever?
That's an order.
Yes, that's an order. So how long is it going to be in the market before it gets executed? There are some others that one day or that can sell the land by 7 in the morning, by night, if I don't get execution, if I don't get whatever put here, the other terminated. Then the last is the clearing instruction, where you are communicating where you want the order to be settled. You know, I think about settlement bank. So where do I want this order to be settled? Yeah. If you are buying stocks, there's always a clearing house. So the clearing house does the settlement. Yeah. But if you are buying a bond, because a bond is OTC, you need to communicate who your settlement bank is. The exchange has trading and CSCs. So the CSCs that does all the settlements. Check see there's only this person's account versus the stocks in this person's account, costings, and all the settlements. Meaning, gives person shares, gives person money, gives person shares, the CSCs that person. But in the bond market, there's no clearing out. So you have to communicate with your settlement bank. Yeah, sorry. So let's go a bit into the market. For the market, you have what we call bid and ask prices. Bid and ask prices. Yeah. I like it. I'm beginning to get tired. I think I'm not yet strong enough. I like to do this. Market maker. No. In your own words, dealers. Remember, I told you that dealers are people that are always that enable liquidity. They always want a free flow of transactions. Then let's put here as the investor for easy sake. Then you have the bid and you have the ask. And I'll give you guys a real life example. For the dealers, the bid is where the bid price, these are prices, yeah? We call these quotes. Yeah? So the bid is the price they want to buy. While the ask is where they want to sell.
Same person.
Yes. So I give you a price that I want to buy for you, and I give you a price that I want to sell to you. So as an investor, this is where you sell. This is where you buy. Because the person that is dealing the market wants to buy here. So as that's where you sell. The person, imagine them as doors. If I put 2 doors here and I stand behind and I say, this is where I'll buy, this is where I'll sell. So it means that anybody that wants to sell will enter this door because that's where I'll buy from the person. And anybody that wants to buy will enter this door because that's what I'm selling to. Yeah? It's just like your Aboki market. Have you ever tried to talk to BDC guys? Or you got to be able to so that you won't buy and you won't sell. Once you say, I want to buy, that means yeah. You want to buy, 1,200. Okay, 1,200. Okay, you can really buy it, I won't sell. You won't say, I won't buy. No, I won't say. Oh, you won't say, okay, 1,995. So anytime you say you want to buy, they will always give you a higher price than anytime you tell them that you want to sell. That is why your bid price would always be lower than your what? Your ask price, because the guy would always want to buy at a lower price and sell at a higher price. Mr. Samuel, does that make sense? So every time you go to Aboki will tell you, Aboki will never have one price. If you ask Aboki, I won't buy $1, I will say, you sure you won't buy? Yes, I won't buy. 14.95. Aboki will tell me how much slap. You just say, Oga, when are you buying? Check out now, what are you buying? I buy for 14.90. Now 14.90 I buy at the market. So now 5 naira we are giving 14.90. Okay, 14.90. You need to do. But if you tell him, I won't sell $1. You won't sell $1. Dollar now 14.90. So you buy at a lower price and sell at the higher price. So if you are buying, you buy at the higher price and sell at the lower price. That is how the market works. And that's what we call the bid and ask price. The bid and ask prices. The difference between the bid and ask prices is what we call the bid and ask spread. Now, remember that. I'm sorry. Remember that there are different abilities in the market. There are different abilities in the market. All of them will give you different prices. Yeah. The highest bid. Remember that when you want to buy, the guy that gives you the highest bid says that you sell. Okay. And the guy that gives you the lowest ask, especially that you buy from. Okay? So hence, the highest bid and the lowest ask is what we call the market price. So if anybody should hold that, what's the market price of $1? I'll tell you to hold. I'll call 6 to 7, 6 to 10 of them. Write down all their prices. Then the one that has the highest buying, the highest bid, yeah, is the one that I will call the market. And the one that has the lowest ask is the one that I'll call the market. So that's how I know the market. And it's the same way for what stocks. We go to the stock market now. The highest bid is what makes the market. The lowest ask is what makes the market. The difference between both of them is what we call bid and ask spread. Bid and ask spread. Okay, let's move to execution instruction. Sir, the lowest, there are several dealers in the market. There are several dealers in the market.
Yes.
Yeah. Can you hear me now?
Okay, yes, I can.
There are several dealers in the market. Yeah. The highest bid makes the market, while the lowest ask makes the market. So your market is the highest bid and the lowest ask, such that the difference between those two is what we call the market bid and ask spread.
If I get you lowest ask higher, right?
Yes. Yes.
Lowest ask higher.
And the bid is always lower than the ask.
Yes. The bid is what?
It's always lower than the ask.
So is that lowest tax?
No. Naturally, the bid prices are always higher, are always lower than the ask prices. Aboki would always quote a bid price that is lower than the ask price.
For each individual, I think it's mixing it up. For anyone that
For every dealer, they will always give you a bid price that is lower than the ask price. When you now talk to all the dealers, the market will now be among all the dealers, the guy that has the highest bid and the guy that has the lowest ask will now become the market.
a question can
That's what I'm saying.
you can maybe the person have the person have
It's
the
not the market.
Yes. They don't necessarily have to be the same person. They don't necessarily have to be the same person.
Okay.
They don't have to be the same person. Whoever has the highest bid, whoever has the lowest ask, they don't have to be the same person. That is the market. So anybody that wants to buy will go and buy for the guy with the lowest ask. Anybody that wants to sell will go and sell to the guy that has the highest bid.
Yes, that's fine, that's clear.
Okay, so moving to execution instructions. Execution instruction. Under execution instructions, we have different types of instructions. We have predominantly market orders and limit orders. What is a market order? A market order is an order that is said that instructs that whatever the market prices, take it. So if I send a market order, that order is going to the market, is going to look for, if I'm sending a buy order, that order, a buy market order, that buy market order is going to the market, it's going to look for the what? The lowest ask. I will pick the lowest ask. If I send a sale market order, that sale market order is going to the market, it's going to look for the highest bid, pick exclude the highest bid and move on. So those are market orders. But the limit order is that you are putting a condition on your order. So you are buying, if it's a buy order, you are telling them that if it's a buy order, you have to, if you are selling a limit order, you have to incorporate a price. So let's say I want to buy at 20 naira. What I am telling them is that, and it's a buy limit order, what I am telling them is that I don't want to buy at a price higher than 20 naira. And if I'm sending a sell limit order, what I am telling them is that 20 naira. What I'm telling them is that I don't want to buy I don't want to sell at a price lower than what 20 naira. So those are the differences between a buy market order, and a limit order. There are other different types of orders. Different types of orders. Or rather instructions. So this one, can you see the board? This is what I was saying. So this is your bid, your ask. This is the highest bid. That's the lowest ask. So the market becomes what? 26 and yeah, 26 and 58. Okay, so validity instructions and term instructions. Remember, I told you that your order has 3 instructions. The execution instruction is what we talked about. Now, in terms of validity, the most common one, like I said, is plain order.
you send the order to the market and you tell them that this order is also for you. Order to be then there's another order called good till cancel order. Those are the orders that okay, cross the 20. So good till, so I said, remember I said there are three aspects of the orders: execution, validity, and clarity. The execution is what we're talking about. Now for validity, the most common one is the order, where you send your instruction guiding and it ends that after that the order is not executed, the order is that's the end of the order. You have to issue another order again. But there's another order called good to cancel order. That's the order that if I push it to the market, it will be available in the market until I either cancel it or it gets executed. Yeah. Then there's another one called immediate or cancel order. That's the one that if I send it to the market, if it doesn't get executed immediately, it's cancelled. That means that order is instant. Yeah. Then good on close. Good on close means that it's an order that it is at the end of the market that it gets. So there's good on close and there's good on open. Good on close is order that will execute at the close of the market, while good on open is an order that will execute at the open of the market. Any other time during the day, you cannot execute that those orders. So if I tell you this order is good or close, that it means that you will only execute it at the end towards the end of the market. And if I tell you the order is good or close, you can only execute it at the beginning of the first 30 minutes of the market. Then we have something called stop orders. So we have something called stop orders. So stop order is an order that you send to the market when you have an open position. Meaning that if you are either short or long, so if you are long and you send a stop order, what I'm trying to tell them is that you are telling them to execute the opposite position of that open position at a specified price. Let me explain. So I have an investment in Zen. I have 10,000 units of Zen Bank. I can send a stop order to the market to say, if the price gets 40 naira, sell. Yeah. Most times, stop orders are used as a risk mitigant. Let's say, for instance, price is falling. I can send a stop order to the market, to the market, and feel price is falling. Once it gets 40, sell everything I have. So, most times, a stop order is always a limit order. It's like a limit, so sometimes most people don't stop limit order. So it's always a limit order. So I told them that please don't sell my stock below this particular price. Once price gets to this particular price, please execute one at once. Don't waste time. So that is what the stop order is. So stop loss order. Yeah. They used to stop loss. So when you want to stop a loss, you send a stop loss order. Clearing instructions, like I mentioned, most times clearing instructions are information pertaining to your settlement bank. But if
it is an exchange, you most likely will not use a settlement bank because the depository will most likely execute. And sometimes, if you have a custody account, it is your custodian detail that you provide to the other party for settlement. Okay, I almost get it to the end. Now, there are two types of security markets. We have secondary market and primary market. Secondary market and primary market. Now let's start with primary market. Remember I mentioned that primary market is a market where investors engage issuers of the capital directly and issuers of security directly. And most times the issuers of security are the organizations or entities that need the money, the capital directly. Does that make sense? So, a primary market, let's say for instance, Dangote needs 1 billion naira. Dangote issues a bond. That bond that Dangote is issuing, it is the primary market is issuing. Every investor that is interested in that bond is going to give that money directly to Dangote. So anytime an entity places capital, either through debt or through equity, and the money is flowing directly to that entity, it is a primary market issuance, meaning that you are issuing that security in a primary market. And that is why at the primary market you always get something called initial public offering. Initial public offering is when a company is offering its securities to the public or to the investors for the first time. Whatever money that is raised from that offering goes directly to the company. Yeah, so that's what we call primary market, where investors interact directly with the people or the entities that actually need money. Yeah. Now, season offering is when the company comes back to sell more shares or issue more security. Because that's not the first time. As long as it's not the first time, it is no more an initial public offering. It now becomes a season offering. Now, secondary markets is when investors trade amongst themselves. So, if I buy shares and the money that I pay for buying those shares is going to another investor, it means that is a secondary market. It means that is a secondary market. It's no more a primary market. It becomes a secondary market. So, public offerings. Public offering. Public offerings. There's something called public book building. So public offerings are always managed by investment banks. So investment banks are the guys that assist institutions to raise capital to do public offering. So what the company is leveraging on investment banks network of clients. So the investment bank will tell you I have a good network of clients, and I can tell you that your offerings will free subscribe. So let us help you to build that capital. Yeah. So they do something called book building. So the book building is they reach out to all their clients in something called a roadshow. So roadshow is they carry the entity to all their client investors so that they can meet, discuss, so that investors are comfortable with the entity, investors can ask questions, and all that. And once they are done with that, they will now do something called a book building, where now you met the entity. The entity has told you what to do this capital. The entity has told you what to do the capital. The entity has opened up its books.
we believe that entity has answered all your certifications and questions that you have. Any question that you like that, I'm sure you need that to be that you've done that, you say you want to ask that. Yeah. So after you've done that, you not send like a I don't want to see that. Like I'll call you, I just want to see that. Instead like a teaser and show your interest. So now that you know everything about this transaction, show your interest. So we are going to invest, how much we invest. So you use that, then at what rate, let's say they get, let's say it's wrong, at what rate will you be willing to offer your money to this client? So that helps give an idea and sense of what investors are thinking.
What the difference?
What you think? Right share.
It's not like offering.
Bro, you're not following me.
No, I'm trying. I'm not going to go away. We haven't talked about shares here. But what I'm saying is public offerings. It's just like asking people to invest in that.
No, I'm not following me. I'm not following me. You are following me, you don't understand. I'm not following me. What is the initial public offer? It's public offer. What is the initial public offer? So public offer is where a company offers its securities to invest. That's simple. It's different from buying shares. So it depends on what kind of security that they are offering to the public. So if it's shares, then you are buying a share. But public offering can either be initial offering or season offering. The initial offering is when I'm doing it for the first time. It can be bond, it can be shares, and for as long as I am trying to raise capital, in order to raise capital, I am issuing a security.
Which can be shared or shares. That's what I'm asking. That's why I'm saying that when you offer this one, like we really offering to go like come and invest in it.
Come and buy the shares, or come and buy that bonds, or come and buy whatever.
And what I'm saying is, even if you are not offering this right now, the market is still there.
You have to do this first before you get into government.
And that's what I'm asking now.
You have to do this first before you get to the market. You have to do a primary market first before you get to secondary market. That's people have to, investors have to first buy your share, whereby if money flows from them to your company. Before you now take them to the stage where they can now buy and sell their own themselves. So that buying and selling on themselves is secondary market. The fact that I am offering to public and money comes to me is primary market.
What they are not buying at the exchange is what you are already sold.
What I already sold. So you
The
first
investors that are not getting more money.
that I'm buying and selling.
So that secondary market doesn't come out to the company. So you think that the profits are
You see the same. Whatever you like to do, you like to do. After that, you know it.
so in essence now is whatever I do on the stock exchange really does not affect the that's
You step at the time.
and I don't want to know
Step at the time. Let's do step at the time. Don't let us get ahead of ourselves. Step at the time. Yeah. Okay. So, have you heard of something called underwriting? Yeah. So what underwriting? Not insurance. Not insurance. I know you are capital market man.
zero like
It's insurance and because you know what underwriting is.
So underwriting is when, remember I told you that when a company wants to raise capital, it goes to an investment bank. And it can either issue shares or issue debt. Now, remember I told you that the bank is leveraging on its network of clients to raise that money on behalf of the company. Now, what some banks do is they have their own money. Yeah? So they will tell the investor, the company that don't worry, we want to raise 100 billion naira. Don't worry, we will give 100 billion naira. However, we will sell those shares to our own clients.
So,
The bank. So that's what I'm saying. A company goes to an investment bank to say, come and help me raise money. The investment bank is leveraging on the network. So what does the investment bank do? You will carry the company and try to lead the company to its clients. And so yeah, we will go and invest in this style. That's normal book building, roadshow, and all that. But under the underwriting process, the investment bank will tell, there are two ways to it. The investment bank will tell the company that we'll give you the money. Don't worry, we'll give you the money. Give us the shares. Now we're going. We will share, we'll sell the shares to our clients. So technically, the investment bank has taken on this. Yeah. But you see, the way you are taking on this, you are also taking on profits. You know why? Because the moment shares get listed, it's the only one that has the shares. So anybody that wants to buy is what they're taking price.
think price. Even those it's more than what.
That's scenario number one. Scenario number two is I will tell you that I will take you through the process, I will introduce you to the clients. However, if you want to raise 100 billion and there's any shortfall, meaning that instead of raising 1 billion for 100 billion for my client, you end up raising 40 billion. That's 60 billion that you do, I'll cover it. The rest of it, I'll cover it. So what happens? Once I cover it, I now own 60% of the shares of the company. Then what do I do afterwards? Once it gets listed, I start to sell that inquiry. Yeah. They don't do it right. Just do it right. For every market, it's pay. Then the other one is what we call best efforts of winning. I will do what I can do. Yeah, I will try my best. Anything you need. Go out the SEC has countered that by saying that you must have a minimum. So we must at least do 50% of the offer. Anything less than 50%, the capital offering as well. So that's why you always see all these investment banks at the other version. We ensure that we use that minimum.
So, what are the investment banks?
So there's something called private placement. MTA. First thing they raised capital there was for private placement. Private placement is when you get a selected group of people, mostly HLIs. Not more than 10 of them. Then you offer your shares to them directly. So you're not doing what people. They're not calling you. So you just some selected few people to offer your shares to them. When you become shareholders in the company and collect money. Yeah, that's too regulated like that.
Yeah, eventually, MTN later. But they manage it because
That public offering was the first time to this in Nigeria.
and that was
They didn't need to listen.
that was first my question. But I saw that they were doing fine. They were doing
It was the first time to listen. They didn't even need to listen.
so sometimes the regulations come.
Ah,
Well, it just it's basically
so it's not my first to listen. It's not my first to listen, but regulation can force you to. You know, government is not, government for 20 years, I've been for 20 years now. Come and pay this fire, pay that fire, pay this one, pay that one. So in the end of the day, you know what, let us listen. That's what people want us to do at the because Nigerians tend feeling like, the government tend feeling like we're limited of money. So say that, but yeah, let's go on. Let's say what's the importance of secondary market to primary market? The secondary market is important to the primary market because the secondary market acts as the liquidity venue for investors. Because when you buy a company's shares, you are intended to hold that shares forever. When you invest in a company's bond, you are expected to hold that bond to maturity. But what if your interest in that company changes along the line? The company cannot, you cannot go back to the company and say, yeah, take back your shares or take back your bond. So the secondary market acts as the liquidity venue for investors where they can buy and sell their shares at will. So without, I told you before, without the primary market, we can't the secondary market. The secondary market exists because of the primary market. Okay, moving on. Secondary security market and contracts market structure. So let's talk about the secondary market structure. So most markets are continuous trading. They are continuous trading markets and they trade within a particular time frame. So during that particular time frame, there's continuous trading. So it's not like an option market where the auctioneer has to be there and all that. It's a continuous market. So throughout the whole time period, it is continuous market. So that's why they call it a call market. In a call market, yeah, trades can be arranged only when the market is called at a particular time and place. That's auction. In contrast, in a continuous market, trades can be arranged and executed anytime the market is open. So the market is open within a particular time and they are continuously trading. Options are called markets. Yeah. So our exchanges are continuous trading markets. Let's talk about execution mechanism. How are trades executed in these markets? We have quotes. There are three different types of market structures: quote-driven, order-driven, and broker markets. The easiest is broker market. Our real estate market in Nigeria is the broker market. Yeah. Without your estate agent, you cannot buy it. Have you realized? Without estate agent, you cannot buy a house. Only if you don't invest in building gas, go. Have you? Am I like the most? Even the owner of the, I've seen it driven by somebody wanted to buy the house. He needs the owner. The owner said you can't meet the estate agent.
It's fun. I don't expect to go around.
It has now a content market. A typical example of a content market is your effect family, where it was always deal to deal, and the dealer was always giving to is the FX market in Nigeria. While your other driven market is your Nigerian stock exchange. Your Nigerian stock exchange is an other driven market where the mechanism is based on what? Order matching. Order matching. So somebody has a price. They look at that person's order, there's another person's order, they both of them match the price, they want execute. They match them, execute, trader, dealer. That means for an order market, there must be a corresponding for the position you want to buy, for the position you want to enter, there must be a corresponding position equivalent to your price. Yeah? So I want to buy, you want to say $20, they match both of us. Yeah? But for a quote, you must deal with the dealer, and the dealer must accept your price. That is your FX market, that is your bond market, that is your OTC market. Yeah? So right. I'm sorry, I'm not at my best. I'm feeling very, very excited. Like I want to fit. So let's talk about characteristics of a well-functioning financial market. Characteristics of a well-functioning financial market. Characteristics of a well-functioning financial market. Financial systems of a well-functioning financial system. The financial system allows traders to solve financial and risk management problems. In a well-functioning system, investors can easily move money from the present to the future while obtaining a fair rate of return for the risk that they take. Borrowers can easily borrow funds that they need to undertake current projects if they can credibly promise to repay funds in the future. Hedgers can easily trade away or offset their risk that concern them, and traders can easily trade currency for other currencies or commodities that they pay. If the assets or contracts needed to solve these problems are available to trade, the financial systems are complete markets. So, financial system has complete markets when all the assets and contracts are available to solve the problems of market participants. If the costs of arranging trades are low, the financial system is operationally efficient. An operationally efficient financial system is one that the cost of you trading or transacting in the markets are low. Yeah? If prices, this last one, if the prices of assets and contracts reflect all available information related to fundamental values, the financial system is said to be what? Informationally efficient. So there are three things. Informationally efficient. All available information are priced into assets. Operationally efficient. The cost of transaction is low. Complete. It has all the assets and contracts in order to solve problems. So a well-functioning financial system has to be complete, has to be operationally efficient, has to be informationally efficient. So the three characteristics of a well-functioning financial system is it has complete markets, it is operationally efficient, it is informationally efficient. Regulation. The financial market must be regulated. There must be regulators in the financial market. These regulators can either be holistic, meaning covering the whole financial market, or targeting the different aspects of the financial market. Yeah. So I think it's in UK, they don't have SEC. They don't have SEC. They have what we call Financial System Authority and Financial Financial Regulatory Authority, they don't have SEC. So is that authority that regulates bank, regulates company, regulates market, regulates everything. But as usual, we like to follow American style. Have you noticed that we like American style? Even though we have been colonized by English, we like American style. I've noticed that. So for us, we have a decentralized regulation. So central bank regulating banks, SEC regulating capital market, insurance regulators only yes, another regulators that's how it is in America. But in UK, one entity regulating anything that with 9,000. Yeah. Now, so
That's the
which one? The UK side. So anyway. So in summary, the objective of the market structure. National plan. I think FS, FCF something A. I think it's F something A. Financial Conduct Authority. So to summarize, the objective of market regulation are to one, control fraud, control agency progress, promote fairness, set mutually beneficial standards, prevent undercapitalized financial firms from exploiting their investors by making excessive risky investments, and ensure that long-term liabilities are fully contained. In these few points of life, I hope I've been able to convince you, but not confuse you, that you need to understand market organization and structure. Thank you very much.